Melbourne Corporation has just been created. So it hasn't done anything yet, so its balance sheet, everything is zeros. The first thing that Melbourne Corporation will do is issue shares to shareholders for cash. So now that it's issued shares, let's look at its balance sheet. Notice, cash line item has changed, contributed capital line item has changed. Now, what's going to happen as the company does operations? So we have a new balance sheet. The company's been in business for a while. The balance sheet, notice, lots of things have changed. It reflects what's happened since the company started in business. So now we have another balance sheet. We've frozen the film again, and now that balance sheet reflects what's happened since the company started in business all the way to where the film has been frozen. So we have 4 balance sheets. Each balance sheet reflects a different frame in the life of the movie of the company. Each balance sheet is different because at each point in the movie, the company looked different. So we want to better understand what is reported on the cash flow statement. So what you're looking at is backdrop pictures of what companies do. So let's think about what the company actually does to generate a cash flow statement. So let's start with the arrow, investments by owners. The company goes to that arrow and asks the question, since the last balance sheet, have we received any cash from owners as an investment? If the answer is yes, that dollar amount gets reported on the cash flow statement. If the answer is no, there's nothing on the cash flow statement. The company then goes to the next arrow, distributions to owners, and asks itself, since the last balance sheet, have we paid out any cash to owners as a distribution? If the answer is yes, that dollar amount goes on the cash flow statement. If the answer is no, there's nothing on the cash flow statement for distributions to owners. The company repeats that for every single arrow on this diagram. Once it's asked that question for every single arrow on the diagram, it's identified every single source and use of cash since the last balance sheet, and it has all the information it needs to generate the cash flow statement. So let's think a little more carefully about how does the company actually generate the shareholder equity statement. Now remember, the shareholder equity statement tells us about wealth flows. So let's go back and look at the diagram of what companies do. The company's going to start with the investment by owners arrow. It's going to ask the question, since the last balance sheet, has there been any wealth inflow or outflow due to investments by owners? If the answer is yes, that dollar amount gets reported on the shareholder equity statement. If the answer is no, there's nothing needed to be reported on the shareholder equity statement. It then goes to the next arrow, distributions to owners. And the company asks, since the last balance sheet, has there been any wealth outflows due to distributions to owners? And if the answer is yes, that dollar amount gets reported on the shareholder equity statement. If the answer is no, there's nothing to report on the shareholder equity statement. The company keeps doing this process, asking that question for each and every arrow on this diagram. Once it's asked the question for every arrow, it's then identified every inflow and outflow of wealth since the last balance sheet, and it has all the information it needs to generate the shareholder equity statement. want to make sure that you're comfortable with the difference between the cash flow statement and the wealth flow statement. So if we look at these two statements, we can see the shareholder equity statement that says investments by owners $4,000. So that means that the company is asserting that since the last balance sheet, it had a wealth inflow of $4,000 due to investments by owners. Now, do we know the form of the wealth that the company received? How would we figure that out? Because the shareholder equity statement only tells us that there was a wealth inflow, it doesn't tell us the form of the wealth. Well, that's where the cash flow statement come in. If we look at the cash flow statement, go to the financing cash flow section, we see share issuance of $4,000. That tells us since the last balance sheet, management is asserting, or the company is asserting, that it collected $4,000 of cash from issuing shares to the company. Now, we can't know for sure, but it seems reasonable that if the company received an investment, a wealth investment of $4,000 from the shareholders, which is on the shareholder equity statement, and it said it got $4,000 of cash from the shareholders from issuing shares, it seems likely that the wealth flow was in the form of a cash flow. So these two statements can work together to help us figure out what was the form of wealth inflows and outflows that's reported on the shareholder equity statement. But the fact that the cash flow statement says 4,000 cash collected, that doesn't tell us there was a wealth flow or not. It just tells us about cash flow. So again, you have to keep cash distinct from wealth.